We're going to start with the story about two hypothetical characters, William and Patrick. Both William and Patrick are fresh out of school and they both want to pursue home ownership, but they are going to do it in different ways. William is going to pursue getting a mortgage with a good credit score, and Patrick is going to try to get a mortgage without any credit score. He's going to pursue manual underwriting. Let's first talk about William. William builds up a good credit score as he's getting ready to graduate from college. He does this by getting 3, maybe 4 credit cards and managing his expenses on those cards. William knows that paying off the balance of the cards every month is the best way to maintain a good credit score. Carrying a balance month to month not only means that he pays interest, but that his credit score can suffer. Now, the challenge that William runs into by managing the credit cards as he's pursuing a high credit score is that there's more friction between him and managing his monthly budget. By actively using all 4 cards for various items, he has to reconcile not only his checking account, but 4 additional credit card accounts as he's going through his monthly ledger and trying to track where his spending has actually gone. And while it's possible, this may introduce a friction that makes it so that once in a while there's a month that slips and doesn't get properly budgeted. You see, credit cards not only introduce a friction when it comes to the number of accounts that you have to reconcile, something that I've ran into myself when I played the credit card game here, just like our hypothetical William. But they also remove the natural pressure that you're going to overdraft your checking account if you're not paying attention to where your money's going. You see, when you have just a checking account, you can only spend what's in there. But with the credit card, you can really delay how long it takes for you to realize the expense there. Thus, by involving credit cards, there is a lower pressure to maintain monthly tracking and monthly budgeting. Okay, back to the story. William has his high credit score. He gets out of school and is able to apply for a mortgage right away. He has a credit score that's well over 700, and the mortgage lenders are more than happy to work with him. William is able to get a healthy and competitive rate on his mortgage right out of school and save on his insurance premiums. As the insurance companies look at his high credit score and say, "You're someone that we can trust, you're someone who's low risk." I don't understand why having credit worthiness makes you a lower risk for insurance companies, but that's what the actuaries say. Okay, now let's pivot our focus over to Patrick. Patrick is trying to avoid credit cards entirely. He's a Dave Ramsey follower. He is allergic to debt products of all sorts. He wants to stay away from them simply out of principle. And I respect that. I myself don't use credit cards for similar reasons. But here's a problem. Right out of school, there's not enough work history, rent history, utility bill history, etc. Not enough history in general to exercise manual underwriting. This is something that I ran into myself. But unlike my story, Patrick is going to stick to his guns and he's not going to play the credit card game at all. He is going to rent for a couple years while he gets his career started. And he's going to then pursue manual underwriting 2 years after he's graduated. So not having a credit score seriously delays Patrick getting into a house. The benefit for this moment is he's able to spend this time renting, saving up a larger down payment before he gets into a mortgage. You see, going right out of school and getting a house for William meant that he didn't have as much time to save up a down payment. He probably got his mortgage with the bare minimum, 3.5% that you have to put forward. On the other hand, Patrick is going to try to save up to 10% before he gets his mortgage a couple years down the road. This puts Patrick in a lower risk situation. If the markets were to dip, he's much less likely to be upside down and will have a little bit more freedom to relocate and sell his home if situations dictate that. Now, even though the history's been built up for Patrick after a couple years, he's not able to get the same kind of rate that William got. He gets a mortgage all the same, but that slightly higher interest rate means that he's going to have a higher payment month over month. When you compare the situations, Patrick isn't going to be able to afford as much house as William did with his high credit score. And one more trade-off that Patrick experiences is slightly higher insurance premiums. However, Patrick says this is worth it because he's not interacting with credit cards. He's sticking to his principles there, and he maintains the natural pressure to stick to his budget, to track his expenses every single month. He wants to make sure that he's in a situation where he is naturally encouraged and pressured to be responsible with his monthly budgeting. Okay, we have 2 very different paths in the pursuit of home ownership through a mortgage. And these paths have very serious trade-offs between them. One is not necessarily better than the other. It depends on each individual, their desires, their principles, their values, their circumstances, and what's going to be best for them. I can't come onto this podcast and tell you you definitely have to go one route versus another in order to maximize your financial success. Both paths have their pros and their cons. Some of these trade offs in one plan may be more quantifiable than the trade offs experienced in the other, but they all exist and they are trade offs that you should probably consider if you're getting ready to get a mortgage through either of these paths. I sincerely want you to understand the choices that you make in the pursuit of your hope filled financial future. And as part of your pursuit for that future, after getting a mortgage, we're going to want to get rid of it, right? Well, our main topic is going to focus on two different types of paths that you can take when trying to pay off your home early. Stick around if you don't want to miss the surprising data behind this decision.